Welcome to Silver Heist. Thank you to our returning subscribers and guests. I thought I would have this fireside chat with you while I enjoy an adult beverage. I'm going to share a financial news story with you today. For those that remember the 7 words that George Carlin said you can't say on TV, there are a couple other words that you can't say on YouTube. When the news story talks about financial instruments and they're referring to the GLD ETF, that's something that I have, but I also like to hold physical gold. So when they're singing the praises of GLD, also just think of GOLD. So this story comes to us via Barron's. It's a dangerous market in stocks. These ETFs offer some safety. The spread of has been bad for stocks and many exchange-traded funds that hold them, but 4 corners of the market have shown some immunity. This is written by John Kumarianos. The spread of has been bad for stocks and many exchange-traded funds that hold them, but 4 corners of the market, alternative energy, long-dated U.S. Treasuries, gold, and real estate investment trusts have shown some immunity. Here's how things could play out if the spread of the worsens. Oil and gas-related stocks and exchange-traded funds are almost certainly going to continue their recent declines if the keeps proliferating. The SPDR S&P Oil and Gas Exploration and Production ETF, ticker XOP, was down 25% for the year through Monday, while the First Trust Natural Gas ETF was down 27%. Because of its potential effect on and the global supply chain has caused fears of an economic slowdown, and that usually sinks the price of oil and energy-related funds and ETFs that hold transportation-related stocks. Oil itself has gone from around $60 at the start of the year to around $50. The SPDR Fund counts Apache, Occidental Petroleum, and WPX Energy among its largest holdings. Energy behemoths ExxonMobil and Chevron are not in the portfolio. They were down 18% and 12% respectively through Monday. The First Trust Fund counts Apache, Contra Resources, and ConocoPhillips as its top 3 holdings. They soak up more than 50% of the fund's assets. The Breakwave Dry Bulk Shipping ETF was down nearly 46% for the year through Monday. It doesn't own stocks, but rather freight futures, with a weighted average of around 3 months to expiration, making the fund vulnerable to increases and declines in maritime trade. The fund was down nearly 5% again on Tuesday, following a 7% swoon on Monday. On the positive side, Invesco Solar ETF and Alps Clean Energy were up 27% and 23% respectively for the year through Monday. Both were down nearly 4% yesterday, however. Less demand for energy could hurt the sector, but alternative power producers have the benefit of hope that they will gradually supplant fossil fuels in the future. If industrial commodities are likely to respond poorly to a high-quality bonds seen as a haven asset are likely to do better. The PIMCO 25-plus year zero-coupon U.S. Treasury ETF was up nearly 17% for the year through Monday. U.S. Treasuries tend to rally when investors are fearful, and that should continue if the more. The fund has the added kicker of owning zero-coupon treasuries. Those are bonds stripped of their coupons that trade at a discount to face value before maturity. Because they don't have coupons and don't deliver any cash flow before maturity, they have high durations or interest rate sensitivity, even relative to bonds with similar maturities that have coupons. Because rates have declined lately, the fund has done well. It will continue to do well if the global economy stumbles and rates go lower still. Similarly, the Vanguard Extended Duration Treasury Index ETF was up 15% for the year through Monday. This fund also owns long-term zero-coupon U.S. Treasuries. Despite the overall toll on the stock market, technology and internet stocks have held up well. Growth stocks have outperformed value stocks for the year so far, with the Russell 1000 Growth Index outpacing the Russell 1000 Value Index by 5 percentage points, 3% compared to negative 2.21% through Monday. Accordingly, the SPDR S&P Internet ETF was up 5.5% for the year through Monday. Its top holdings are Stamps.com, Zillow Group, and Pinterest. But tech and internet stocks may not be as sure a bet as treasuries in the face of a The Internet ETF was down more than 4% on Monday. Gold funds have done well, and like treasuries, they may well continue to do so. The SPDR Gold Shares ETF Gold was up more than 9% for the year, including nearly 1% gain on Monday. Gold is another asset that often performs strongly when investors are fearful. Finally, real estate funds have performed strongly, posting gains of around 6%, including a 1% drop on Monday. Real Estate Investment Trust, or REITs, pay out 90% of their net income in order to qualify for favorable tax treatment, so they often trade in line with treasuries, another income-yielding investment, especially when the latter are posting big moves. Since treasuries have rallied so hard lately, REITs have also done well, but a will undoubtedly hurt some property types, notably hotels. And if the global economy experiences a protracted slowdown, REITs as a group will suffer too. Still, REITs generally trade at prices giving them a dividend yield a bit more than 1 percentage point above that of a 10-year U.S. Treasury debt. Treasury yields are near record lows, so REIT yields, dividends as a share of the fund's prices, are likely to remain low as well. The bottom line is that REIT shares could remain more stable than the rest of the stock market. Well, the other bottom line is that you might want to hold physical gold or GLD ETF in your portfolio. If you want to see more about some recent gold pickups, please click on one of our featured videos.